Hello, welcome to my channel. Today I'd like to discuss the efficient frontier. So let's get right to it. The efficient frontier is a curve that shows the optimal portfolio for a given level of risk and return. It is a fundamental concept in investment theory that helps investors make decisions about how to diversify their portfolios. Okay, I'd like to deep dive this and show you what the Paul Merriman 10 fund strategy uh, is, and I want to compare that to another strategy that I have, and I'm currently using the second strategy. The information that I provide here is for information purposes only. Please consult your CPA or financial expert for your own investing advice. Thank you. I was watching a video on the Afford Anything podcast recently, and Paula Pant and Joel Solsihai came out with a new video on the efficient frontier. So I wanted to deep dive into this and to provide some more information and some other back testing that we have available to us. Let's go to portfoliovisualizer.com, and then we want to go to efficient frontier. Okay, I have one of these already filled out, so I will open that. Alright, so in this efficient frontier, this is the information I grabbed from the video that I saw. So they had a large cap value, growth, so mid cap, small cap, emerging markets, short-term treasury, immediate-term treasury, corporate bonds, REITs, precious metals. Don't put any minimum value weights inside of here. Only put your maximum value weights. So this is telling us that it's kind of figuring out what's the best for us, and the max is 30% out of any one of these. Okay, so let's run this test, and this test runs. Okay, I'm gonna go through the top areas right here. So we get asset classes. We got year to year, 1985 to 2024. No, yes, yes, no, no. Okay, and then we'll view what we get. So it ran from January 2003 to December 2024. Okay. These are the max Sharpe ratio portfolio, and it is showing us that it chose 30% in nearly 3 of these, and then 10% in large cap value. Okay, and it's saying that our expected return is 6.42%. Okay, and inside of here, it's showing you, what's a little better, but it chose automatically what it thinks is the best choice for us. And so then the efficient frontier assets kind of runs through that. Max weight, man, okay, so it's return. Okay, out of each one of these, it's telling us what the expected return is, and then asset correlations. Correlations are important. So the farther these are from each other, the better that they are as far as diversified. So you want to have a diversified portfolio. So we got emerging markets here that's pretty far from large cap growth. So they hopefully would, if large cap growth went up, maybe emerging markets goes down, but they should all balance each other out. Okay. And then efficient frontier portfolios. So it's throwing out a whole bunch of portfolios. It's throwing in a whole bunch of different values here. So it's choosing, my guess is it's choosing different values and finding the best ones. Let's see, out of 100 here, yeah, that's where it came. I believe it came from. So it's got 30. Yep, that's it. 30, 29, 30. So it's like, this is the best out of the best. I think that provides the highest return back out of it. So let's look at that 12.3 and that 17.231. Okay. 12.3 and okay, so expected return is that 12.3 with that one in particular. Okay. So let's go to the one that I created, and we'll go here. So let's remember that 12.3. Okay. Now we'll go to the efficient frontier, but now I put in some tickers. Okay. So the tickers, and then we have January 16th, 2024. Before we were much different. Let's see, January 2003. So let's remember this. 03 to 16, so that's quite a bit different. So we can't really compare these apples to apples in this case, but let's see what it gives us. So the value growth ETF, small cap value 600, long-term treasury ETF 6%, and then gold 30%. So it wants us in large caps and small caps, and then a little bit of long-term treasuries. Okay, and then our expected return is much higher than the other one. But again, let's remember that date. This is going by a lot less data. So we want to have that 2003 data that would provide us with more comfortable amount. Anyway, we'll keep going through this, and so we look at the assets, okay, the asset correlations, how well they correlate. So we got gold is very highly uncorrelated with real estate. So gold and real estate should be like very different, which they are. I mean, real estate goes up, and that doesn't necessarily affect any gold. So we'll go now with the portfolios themselves, and we will scroll down to the very bottom. So it ran 100, and this is where it came up with 40%, 40%, and 20%. And it came back with 15.43% on our total. Hold on. Expected return is this third column. So it came up with 14% back on that. Okay, so that's pretty good. Let's go back to what it was. Compare that. Only 12%. So almost a 2% difference there. But remember the date. Now that we have some information on the efficient frontier and we get some numbers from that, let's go do some back tests. And we want to see what the back tests tell us as far as these efficient frontier portfolios. Okay. So let's go to the website, lazyportfolioetf.com. Okay. So this website, in here we have back tests right here. So we're going to go with a portfolio back test and simulation. Okay. First one, we're going to choose 4 different back tests, and they actually have the Paul Merriman 10 fund portfolio inside of here. So I'm going to choose that one, and I'm going to choose Tyler's. All right, in here we'll put in a few different portfolios. So we're going to choose some different ones. Here we get the Ray Dalio. We're going to choose Tyler's in here, Tyler, and we want to choose Tyler's first one. Come on, there we go. The Golden Butterfly. So this one is a pretty good one. The Tyler one, T1. Then we'll put in Pinwheel. So we're not going to put any Bitcoin in here because Bitcoin is a very aggressive item to be investing in. So let's choose another one, and let's just pick one that we may all know. We've heard of Rick Fieri. We'll put in the Core 4 here, right here. Okay, so let's do a back test. Okay, and one thing about this back test is we want to make sure this back test is comparable as far as dates wise to our other, portfolio. So I will show you what the other portfolio is in a minute, but I want to make sure the dates match. We have the same starting date. So this one starts back in January 1976. Okay, so we're going to take this back, and I ran this with a different portfolio, one that was derived from the golden ratio from the portfoliocharts.com. So, and here is some items within the golden ratio, and a lot of this is explained on Frank Vasquez website, riskparity.com. He actually walks through what funds are inside of here, but I actually have them here too. So we have large cap growth. Now these are slightly different because I couldn't find the exact funds that were inside of that the golden ratio portfolio. So I put in adjusted some values here because some of the funds were not available. So we put in large cap growth, small cap, U.S. minimal volatility, U.S. Treasury 26%, gold, and REITs. Okay, and then we are going to run the back test on this one. Okay, we run the back test on that. We notice the back test on this says that we have started in 1985. So we want to adjust the other one to 1985 also, so that we have better comparison. 1985, okay, and then we'll run that back test. Okay, within here we can see they are. So we have 1985 to 2025, 40 years of data. Okay, and this is telling me the Ray Dalio all-weather portfolio. We have a yearly return of 7.68%, and we have a maximum recovery period of 37 months. So what that's telling me is the market could decline and could take you 37 months to get back to your original value. So you may want to have some reserve cash sitting on the side in case something like this would happen, because your worst drawdown was a negative 20% year. Okay. So now we're going to go with the Tyler Golden Butterfly. So this one has a little bit of gold inside of it. Gold is known not to give you any returns, it gives you no dividends or anything like that, but it's a good hedge against inflation risks, stuff like that. So we are looking at that one, and a yearly return of 8%, 30-month recovery period, so 7 months less than the one above, and a better return than the one above, and a less drawdown. So that's telling me something's going on here. It's showing me good results. So let's keep going down. So that actually is not the highest one, but if we look at the Rick Fieri Core 4 here, we get this is our highest amount for yearly return, 8.53, our maximum drawdown. So not only was this the highest, so it's riskiest, but it also dropped down to negative 44% 1 year. It took 40 months to recover back to that, which that's pretty risky. Okay, so let's see on the other portfolio that we have, what exactly did that show us? Okay, so that one here, so this one consists of the numbers that I said earlier. Okay, and then from 1985, I'll just repeat that. So we got the highest return out of all of them. So we got a positive 9.52% return on this one. We have a negative drawdown of 24%. Let's remember this 24%. I'm going to compare it to the other one, and then we'll show you that. Then we have 25 months to recover. So 25 months, just over 2 years to recover. So that means if you had the 24% drawdown, it should theoretically take you 24 months to get that money back up. Or 25, sorry. So let's remember negative 24 for max drawdown and 25 months to recover. Let's switch tabs here, and nothing is that low as far as recovery months. And 25, we only see one in here that gave us the lowest return. So negative 17 was the lowest max drawdown. So this is the safest portfolio, but it only gave us 8%. Okay, 8% compared to the one that I have is 9.52%. So 8%, 9.5, 1.5% extra. That's pretty nice. So over a very long period of time, that 1.5% makes a big difference. So another thing I want to show you is we can actually put in inflation adjusted here. So this will drop down what the inflation was. So let's look at that 9.52 drops to 6.83. So that means we would be comfortable living off of 6.83% off this portfolio, and it would still maintain its level all throughout, your possibly retirement. I'm not going to say you're in total retirement because there's unforeseen circumstances that could happen. But anyway, back to this. So this is showing me, yeah. So I just wanted to show you that one that we chose, the tickers themselves, they actually have a much better return than all the rest. The only thing that we're getting a little more risky because we have a higher negative drawdown, but we have every single one of these it takes more months to recover after you had that drawdown. Okay. I wanted to add one final portfolio, and this was I found the Paul Merriman portfolio in the website. So let's go back to there. Let's add that one. So the ultimate buy and hold strategy. So now I added that one and changed that one. So go to the back test and we're gonna see what that one has, and we will adjust this 1985. That's good. So we get the Paul Merriman Ultimate, which chooses those I believe 10 or 12 stocks or ETFs, and so we can see this one has a very good yearly return of 8.64%, but a huge drawdown. So this is pretty bad, I think, and will take you 5 years. So yeah, you're getting a good return, 8.64%, but you could have the possibility of negative 57% drawdown, and that's 5 years to get over that. That's insane. So the Paul Merriman Ultimate Buy and Hold strategy may not be the correct one to go with. I would say this one here looks to be uh, really safe to me. I'm going to uncheck that. I'm going to go into that 9.52 negative 24%, and then 25 months. So my opinion is this is the best. Please again check with your CPA, tax consultant, or financial advisor, whoever, to get more information on this. So that's all I have today. Hopefully this was insightful and taught you something. Thank you.